And on to Warren Ingram this evening. Warren is, of course, a director at Galileo Capital. He's executive director at Galileo Capital. He's a personal financial advisor. And tonight we're talking FOMO. And I defy anybody not to have been a little bit excited when the gold price hit R1,000,000 a kilogram, Warren Ingram, or when Apple approached the $2 trillion mark in terms of market capitalization, or any one of the other real go-go stories that only become stories when perhaps it's too late for real human beings to invest in them. And that's, I think, what you want to caution us about tonight.
Absolutely, and I think I think it's only fake human beings that can make money like that. Not the real human beings like you and me. And I think if we look at gold as a great example, gold is something that shoots up when everyone's really fearful and worried about the state of the world, whether it's an economic system or a political system or just a stock market crash, and then all of a sudden they look for a safe haven, and their safe haven of choice is almost always going to be gold. And so when we look at gold now, I think. I did a quick check before this, and the whole gold mining sector in South Africa on the JSE is up nearly 200%. It's gone up 2 times in 1 year, and of course now is when we start to get the questions from investors saying shouldn't we go into gold, and we should have been in gold a year ago, but we wouldn't have been able to forecast something like COVID a year ago, and so it becomes. Investing by looking in the rearview mirror while you're trying to drive forwards, it's just not helpful.
Because in dollar terms, in dollar terms, the gold price is up handsomely. In rand terms, if you wanted to protect yourself against a collapse in the currency, gold has actually served that purpose very nicely, hasn't it?
It has. I think it's up about 48%. Again over 12 months. So it's a really fabulous investment if you were in it. And that's my concern, is that we now get caught in by the lure of that shiny metal, and we start to say to ourselves, well, let's go in because I'm sure that this is going to carry on, and so that's a problem. We have this recency bias where whatever's happened over the last 12 months, we project that that's what's going to happen over the next 12 months. And if only that were true. Unfortunately, what happens is that the world changes again, and if the world goes from a state of being very fearful and really worried about what's the future of the economy and stock markets and currencies, and they become less and less fearful because medical treatments get better for COVID, potentially there's a vaccine, then all of a sudden we're in a position where gold starts to lose value, and gold doesn't just trickle down in a nice, easily predictable pattern. What it does is it falls off a cliff, and so I'm really cautioning investors. Don't look at what happened in the last 12 months as a projection of what's going to happen over the next 12 months.
So if we can't look back, then we have to look forward. And looking forward is very difficult, Warren. And it's almost impossible to do. So rather than do that, I'd rather then, if you tell me I can't invest in gold, then you know what I'm going to do, and you tell me I must invest in indices, I'm going to invest in the S&P 500 index, because that's been doing very well too. And if you won't let me do gold, I'm going to do S&P 500. And I'm going to do the index, which is sensible, because you say it's sensible, but now you're about to tell me why it's not.
You're right. I love index investing, and I think the S&P is it has been a brilliant place to put money for a very long period of time. And again, over the last year, it's up nearly 14% in dollars. I wish I'd done the calc in rands. I haven't, but it would be up a lot more than that in rand terms. What's interesting about that is, the tech companies have been a big driver of the S&P 500 over the last while. And one of the ways you can measure that is you can look at these companies called the FANGs, and they get really creative now with making indices. So there's one called the FANG Plus Index, which is really tech-enabled companies, and it's names that we'll all know. So it's Facebook and Amazon and Apple, Netflix, Google, which owns Alphabet. And if you look at that index, it's up nearly 90% over 12 months. So again, a collection of companies that have pretty much doubled in a year, and they are the ones that are driving that S&P 500 index up. And so when we look at that, again, it's been a great place to be in the past. I'm not convinced that that's necessarily where we want to be in the future.
Now,
Because for me,
I've been speaking to people for years about Naspers with exactly the same sense that, well, it's done incredibly well and it can't possibly continue. And what Naspers has done is precisely that. It has continued year in and year out. At some point, though, Warren, sometimes you just have to ride the trend, don't you? Don't shout me or hit at me. You can't hit me because you can't reach me. But that's the argument you will get. And you'll say, well, lots of experts said Naspers wasn't worth 2,000 Rand, and now it's 6,000 Rand if you add Process and Naspers together. So, sometimes, you've just got to ride ride your winners.
I think that there's a great lesson there, and that's not to be too specific and too all or nothing in the way that you invest your money. In other words, if you believe in the tech sector, and to me that's the interesting thing here is that there's a huge business case for the whole tech sector, and maybe just I think it's become too narrow now just to talk about tech, because you could talk about a company like Walmart. Is it a retailer, or is it a logistics business driven by incredible technology? So I think the impact of technology is going to be amazing, and I think it's going to drive a lot of businesses to be more efficient, more productive, eventually more profitable, and therefore better investments for the likes of you and me. But don't make a huge bet just on one sector. So if you still have a firm conviction in tech, and you're right, I mean, Naspers is a brilliant investment story that has embarrassed a lot of us over the years when we've kept saying can't carry on like this. But my argument then will be don't put all of your money into Naspers, or globally don't put all your money into the FANG Plus index or just the S&P 500. Rather look for a spread of investments, and I think that's the key when you make investment decisions is you're really going to do well if you try and make small incremental improvements in your growth of your investments over long periods of time, rather than saying it's to use a cricket analogy, it's six or nothing. And I think that's the point here is if I'm going to invest in something like the tech index, that's great. But what I'm going to do is I'm going to take a portion of my money, and maybe if I'm in a global market, maybe it's going to be somewhere around 10 or 15% of my money, and I'm going to put that into the global index. But then I'm going to look for the things that are moving in the opposite direction to that index. What are the things that will perform at different times and have different drivers of growth from a tech sector? And over the last decade, we look at things like emerging markets. They've really performed terribly in dollar terms over the last 10 years. And I think for me that represents a really nice opportunity, because what we're looking for when we make investment decisions are the things that are going to grow over the next 10 years, not the things that have done really well over the last 10 years. And so emerging markets are to me a great value opportunity. But that doesn't mean I go and put all my...
Yeah, but in the same way, as you say, don't get too hooked up on the trends, and don't be, to be careful of FOMO, because once you've missed out, and don't try and play catch up. In the same way, just because things have not performed for the last 10 years doesn't mean they're going to perform in the next 10. Sometimes, your Venezuela exposure or your Zimbabwe exposure, and some people would argue South Africa exposure, could let you down incredibly badly over the next decade, just like it did in the previous one.
Absolutely, and I think it's to understand why those emerging markets will do well, and also what are the biggest parts of that emerging market index, and it probably won't surprise you to know that it's going to be China, it's going to be South Korea, it's going to be Singapore, it's going to be Vietnam, Indonesia, India, and those, if you look at their demographics and if you look at the productivity and especially the productivity growth of their population and of the businesses that they've got there, and the growth path of the whole economy, ultimately, an economy that grows at 5 or 8% a year for 10 years, if you can buy shares in an economy that does that, you might not make money over a year or two, but you certainly will over a longer period of time. So I think it's, any investment decision you shouldn't be doing on blind faith, or just because, it's done the opposite of what everything else has done, or, it's really performed over the last year or two. You have to apply your mind and understand why you're making those investment decisions. And to me, I think, emerging markets are going to be one that will deliver in the next decade. But again,
what is it about us, though, Warren? What is it about us that makes us want to chase the hottest thing on the block? What makes us fall into the trap time and time again? I mean, if you look at the way people, and again, don't hit me, because you can't, is when we were going to the ANC elective conference in 2017, and Bitcoin was going mad, and South Africans were throwing money at Bitcoin like it was a proper investment, and it went up to like $20,000 a coin, I think, and people have lost fortunes on that simply by panicking in and panicking out afterwards.
So I think two things. I mean, one, it's either fear or greed. When we see everyone else making money, and especially when they're talking about it and telling us about the great success that they've had with this one particular investment, and let's use Bitcoin as a great example of that, they won't talk about the other 12 coins that they bought that all blew up and went to zero. They'll only talk about their Bitcoin that did incredibly well. And then we're sitting there, around the virtual dinner table with them, saying to ourselves, "Well, why are we missing out? And isn't this my opportunity to kind of break out and get into my billionaire status as quickly as possible?" So that's the greed. Or the opposite of that is the fear. When you live in, if we think back to 2017, it was an incredibly fearful time for all of us, and now might be another situation where we're living in a lot of fear. And then we latch onto anything that gives us the opportunity, or the hope, I should say, rather, not the opportunity, of growth and some kind of safety net. And that's why people play the lotto, right? I mean, if we understood the odds of being in the lotto, we would never put money in there, because it's always going to be a bad decision unless you are the one in whatever it is, 2 billion person that actually wins the lotto, and all of a sudden, it was the success story of note. And I think that's a bit of how people look at these kinds of investments. They go from making rational, sensible decisions, looking at good probability decisions around things that will grow, and they start to gamble. They don't say that to themselves. They tell themselves a story, and we've all done it in our investment careers where we get sucked into the hype. It could be hype around fear, so we sell out of the stock market or shares because we're really worried about the future, and we're listening to everyone around us. And what happens? The stock market turns and it absolutely booms. So fear could be just as big a driver of bad investment decisions as greed. And unfortunately, we are human beings. We are ultimately, in our core, we are driven by fear and greed. And so, when we look at this kind of market that we're in now, and we look at how the world is so uncertain and so unstable, we've almost got to try and find ways to become more robotic in our nature when we look at investments. It's great to be a good human being when you're talking to other people, but when you're looking at your money, you want to try and be as close to a robot as you possibly can. And I think that's the key here is, how do you make sensible decisions, and how do you spread your risks, and take smaller views if you really still believe that the tech sector is going to be the next big thing for the next decade as well. But don't go huge on that. And the same with gold. I grew up in a time in stock markets when we used to laugh at people that talked about gold, because gold did nothing for a decade. And we had these older people in the investment industry telling us about when gold used to be an incredible investment. And so my framing around gold is terrible, because I think I always believe it's going to go down, because that's how I grew up in the gold market. And I think for me, I've got to fight that human emotion and say, no, there will be times when gold has a role to play, just like there'll be a time when tech has a role to play, but it won't always be the case. So it's a case of spread. Spread your risk, spread your decisions over time. Be careful of getting sucked into the emotions of markets, especially fear. But in this situation, I think I saw on Takiso's timeline someone talking about Sasol, and saying, well, gee, we should all be in Sasol now because that's recovered really nicely. But again, that would have been a great decision when Sasol was at $50 a share, and I would have probably said to people, I'm sure I did, be careful, because it's priced to either go up really well, or it's priced to fall over and die because it's got too much debt.
But you got people who look at Sasol at $150 or $160 today, and they say, well, it was once at 600, so therefore it'll go back there, and there's no guarantee that it's going to do that either. And the odds of it going back to 50 are probably as high as it going to 600, simply because we don't know if they're going to raise new capital. The odds are lower than they were 2 months ago, but it's still a business that is behind time and over budget, and all kinds of problems in Louisiana and in other properties. So sometimes too much knowledge is also a bad thing. You get yourself stuck into this holding pattern of indecision, which is, I think, quite concerning too.
Agreed. And I think when I don't know what to do, I always spread my risks far and wide. And I do that in, so for example, in a situation like now, if people said to me, what would you do with your money? And you're a global investor, I'd say, well, I'm definitely going to buy the world stock market index. And that'll probably make up, somewhere between half to 2/3 of my investments. I'll take a view. So I'll take 10 or 15% on emerging markets. And then I'll probably retain a bit of cash just in case things fall over again, and the markets become extremely fearful because they realize COVID is a much bigger problem than everyone thought, and there's no vaccine. And then I'll deploy that cash into the markets if they really are going to fall over. But I think spread your risks, and don't be too big on your calls, either up or down. If you think the world's going to fall apart, don't sell all your shares, because just know you're wrong, and then you'd be really grateful to have some money in the market still.
Warren Ingram from Galileo Capital is a personal financial advisor and an executive director at Galileo Capital.